Okay, welcome to a micro video, and in this short topic video we'll spend a few minutes looking at the key features, advantages and potential drawbacks of a free market economic system. An economic system is probably best defined as a network of agents and organisations that is used to resolve the problem of what to produce, how much, how and for whom to supply goods and services. And a free market economy, otherwise known as a laissez-faire system, is advocated by many free market economists, particularly in the Chicago and Austrian School of Economics. Free market is a system of buying and selling goods and services that is not under the direction and control of a government. People can buy and sell freely, and most companies and property are owned privately and not by the state. The means of production are owned by the private sector. Crucially, there is a lack of government intervention. There's limited intervention to influence or change the outcomes of market activity. Goods and services are distributed according to the price mechanism as opposed to some form of price control. There are many different aspects of a free market system. In its purest sense, it's where the economic problem of what to produce is solved by consumers expressing their tastes and their preferences in their patterns of spending. But typically in a free market system we have fairly light touch, unobtrusive regulation both of labour markets, product markets, that's goods and services, and also light touch regulation of financial markets. The legal system has a key role in terms of protecting the right to own property and the right to own other factors of production. There is freedom to trade internationally and promote the free movement of capital and labour. So in a free market system, there will be the relative absence of things like import tariffs, quotas and migration limits. Typically, as we said before, there's limited market intervention by the state through things like indirect taxes, subsidies and price controls. Governments are often quite small, both in terms of their own spending on goods and services, limited public ownership, and a relatively small size and scope for welfare. Often free market economies are characterised by being low tax environments with a particular emphasis on the ease of doing business. And consumer sovereignty is the main way of allocating scarce resources. The Heritage Foundation is a free market think tank, and they publish each year an economic freedom index. They define economically free societies as where the government allows labour, capital and goods to move freely and refrain from coercion or constraint of liberty beyond the extent necessary to protect and maintain liberty itself. Now, we need to know where these people are coming from. They're coming from a free market capitalist perspective. They publish every year an index of economic freedom. To calculate it, they take I think something like 12 different factors, including the rule of law, the size of government, regulatory efficiency and the extent to which markets are truly open. And Hong Kong and Singapore came top in 2019, with New Zealand and Switzerland in third and fourth place respectively. Another useful index is published by the World Bank, and they publish a data ranking of countries where the ease of doing business is greatest. New Zealand came top of the most recent figures, with Singapore and Hong Kong coming in second and third place. Free market economies typically are supported by those who think that capitalism is the best system for allocating scarce resources among competing uses. So they argue that free markets are an efficient way of allocating scarce resources. Resources are driven by the profit motive. Competition between suppliers helps to keep prices down and the quality of goods and services up. Competition in free markets is a driver of innovation and invention, which has the positive spillover of higher profits for businesses and their shareholders, but also better products for consumers. And it's argued that the profit motive stimulates capital investment, which allows for economies of scale, and those lower costs can again be passed on to consumers in the form of reduced prices. And generally, of course, free market economists believe in the efficacy, they believe in the potential of competition, including through trade, as a way of helping to reduce domestic monopoly power and increasing consumer choice. On the other hand, of course, free markets can fail to achieve an economically and socially efficient and equitable allocation of resources. There are numerous potential causes of market failure that may indeed require government intervention. So some of the potential disadvantages of free market systems include the potential for a rise in income and wealth inequality, perhaps seen by an increase in the Gini coefficient. Businesses can develop and sustain monopoly power and force consumers to pay higher prices for oftentimes essential goods and services. The free market may underprovide or not provide at all pure public goods, such as defence, goods which are both non-rival and non-excludable. It's often argued by economists who favour state intervention that the free market tends to underprovide merit goods, such as basic healthcare and education, which many people, particularly households on low incomes, couldn't afford if it was provided by the private sector. And that under-provision of these things can lead to a fall in social welfare. Free markets on their own, without intervention, may fail to address the negative externalities from both production and consumption. And we've seen that markets can be unstable, unpredictable, particularly the risks of financial excess and contagion and systemic risk coming from lightly regulated financial markets, which are often prone to bouts of instability, perhaps prompted by the irrational exuberance of investors. And of course, the fallout from the global financial crisis affected millions of people, hundreds of millions of people not directly involved. If you want to capture the essence of this, I suppose you might say that the economy of billionaires and food banks is not necessarily sustainable. So there we go, a quick look at the free market economic system.